some people plan and some people don't. Not to bring it back to music. Obviously, I love music. It's what it is. But when you sort of look at the two estates of Prince versus Bowie, and you could argue David Bowie, you could argue that both of those are companies in and of themselves. One was a total train wreck disaster, and they're still suing and still trying to figure that out. The other one is a marketing machine right now, and it's producing probably a ton of income for that particular trust. So I'll let you you could Google it and probably guess which is which. But
So who do you
anyway,
want to be,
again,
Prince or Bowie? Yeah.
Welcome to Planning Reimagined, a podcast from the planning experts at Robin Glen and RX Investment Partners for wealthy families and successful business owners.
You built your business from the ground up, and now you're eyeing that exit sign. But before you rush towards it, what if there are ways that you can not only reduce your tax bill, but also walk away with more money in your pocket? Today, we're diving into the world of pre-sale planning strategies, which could be the difference between a good exit and a great one. Hi, I'm Celeste Moya. Welcome to another episode of Planning Reimagined, where your wealth journey meets our expert insights. Today, we're continuing our series on business planning with a really important topic, pre-sale planning, to maximize the value of your business and also to reduce your tax exposure. So whether you are deep into exit planning or you're just starting to consider it, the information we're going to share today is going to be valuable for you. I'm thrilled to have two experts from our very own Robin Glen team with us today, Chris Stiegel and Mike Mazzoni. Chris is our advanced planning guru with decades of experience in tax mitigation and wealth protection strategies. And Mike is our resident JD, CPA, LLM. I say a little bit smart, who he's worked with countless families and business owners in planning successful exits. So thank you both so much for joining us today. So let's just get right into it. Let's start with you, Chris. If you can share a little bit about, why is pre-sale planning for business owners so crucial, and how early should they start thinking about these strategies?
Yeah, no, that's a great question because honestly, pre-sale planning is absolutely key to getting the most out of a business that someone spent probably a ton of time building. And for those looking to sell, I think that there's certain aspects of the business that help drive the business value, and I think this is where most business owners see like the big numbers and they get super excited about this big windfall they're going to have. So I think a lot of companies, a lot of individuals, company owners spend a lot of time trying to get their financial statements in order, like doing audited statements, which helps build that trust in potential buyers. I think they work with their management team a lot and some of their advisors to sort of address some of the risks and help identify areas where there could be potential problems. So again, just trying to get ahead of some issues that the company might be having. And I think that some of them actually, can be proactive and get, business valuations just to get a sense of what, the current value of their companies are to help, again, identify and address any areas of the company that could ultimately increase the value of the company prior to market. But honestly, that's just part of the story because that's just how I think a lot of business owners think about how to maximize their business value. But it's just part of the equation. Pre-sale planning, it also gives people time to sort of emotionally prepare for that transition. But then there's also the personal financial impact of the sale. And I think that's where we're going to spend a lot of time talking today. And this is really where tax and estate planning come into play. Because honestly, with some foresight and without disrupting, the value of the business, some planning around taxes can make a huge difference in ultimately how much somebody might net from their business once it is sold. So, to go back and answer your question a little bit, the best time to start this kind of planning, whether, you're doing the financial statement, trying to get, your ducks in order prior to sale, or if you're thinking about income tax and estate planning, ideally, the best time to start is today. But the reality is, if you're going to do that, you think that your business is going to be sold, I think 3 to 5 years in advance is really kind of the sweet spot of where people should start looking.
We had a guest in a previous episode that said you should start with the exit in mind, right? Because you just never know when that exit's going to come. Sometimes they're planned, sometimes they're not. We've also seen business owners that weren't planning to sell, and all of a sudden that great opportunity came about, and they may have been ready or not, right? So it's really getting all of your house in order. And ensuring that it's in order at all times. So if that time comes, it's not, it's easier to do it. So Mike, there's so much that is involved with exit planning. So I know that today's topic we could talk about all day long, but let's start with from your experience, what are some of the biggest mistakes you've seen business owners make when they don't engage in proper pre-sale planning?
Sure. So, before you go to market or bring, a banker to the table to kind of start shopping you, I think, I hate to say it as an attorney, but one of the most overlooked things that I see, especially when you have a company that maybe was kind of bootstrapping it for a little while and all of a sudden they hit their sweet spot and they accelerated growth to a point where they're being an attractive asset for someone to buy is, really getting with your corporate attorney and making sure that your house is in order, right? Your operating agreements, your shareholder agreements, your employment agreements. The amount of times that I've worked with groups who don't have an up-to-date, cap table about like, okay, who actually owns what of this company. They quote unquote issued stock options. And when you say, okay, can we see those documents? It's like, well, it was mainly like email back and forth, and we kind of agreed that he's going to get this instead of that, or she's going to do this. It's fine when you're small, but if you want, when you want to look professional to the outward market, it's really, really important to get all those things in order so that you can, hit the ground with your best foot forward when you do have a potential buyer.
Yeah, absolutely.
Second one I see most of the time is kind of keeping your key employees, or maybe not key employees, in the dark that you are thinking about, going to market, because they'll know, right? When you're having the internal accountants do a bunch of different analysis that they typically don't do. We're setting up, different, forms for the iBankers to go out to market and like really pitch these things. Like they have a pretty good understanding that something's happening. So I think just transparency, helping those key employees understand that, maybe giving them certain benefits of an exit, maybe some of the lesser key employees, some type of exit bonus will really keep them incentivized to help bring this thing to market in the best shape possible.
Yeah.
And then lastly, it's, not only working with your attorney, but working with your CPA to do some modeling as far as, what's the best exit net of tax for you? Is that an asset sale? Is it a stock sale? Are we maybe spinning something off and then selling that? I think understanding how you want to be purchased is the most overlooked item, because once you go out there and you start collecting LOIs and, they all say asset sale, or we want to purchase your assets for X. And then you go back to your CPA and say, hey, how's this look? It's like, well, if you do a stock sale, you're going to save 25% more tax. And you say, well, just kidding. I'd actually like you to buy my stock. Like that looks unprofessional. People don't really have patience or time for that. So really understanding how you want to approach the market as far as instead of spin off of a certain branch or an asset sale or a stock sale, knowing that and approaching the market like that, as opposed to kind of bait switching potential buyers. I see that a lot, and that leads to a lot of confusion and mistakes.
Yeah, and I mean, it has to be so important because maybe that offer that was on the table, if you're kind of going back and forth, will not be on the table anymore, right? If you've decided to change your mind last minute. And something you said is super important. It's just ensuring everybody in your organization that is crucial, particularly to the organization, is aware of it. I think sometimes business owners feel like, well, it's my business, I'm going to do whatever I want, but they forget that those key employees are also part of that value in the business. And so it's really important that they all have that buy-in before they start hearing the rumblings and maybe go find a job with your competitor before that sale comes around, right? So
absolutely. I mean, yeah, just the velocity of today's M&A market, you really need to make sure that, that you look like you are a fully functioning, great asset to buy. And if you don't have corporate record books in order, if you don't know how you want to be bought, you kind of waffling on, oh, actually, could we do a stock sale instead? Like that just, private equity groups, certain groups who are buying companies, they just don't have time for that, and they become disenfranchised relatively quickly.
And they don't want surprises, right? Another guest mentioned they worked with a business that had a tax lien they didn't know about. So that's a very big problem to the buyer. Right. So, it's making sure there's no surprises. You have everything in order. Absolutely.
Like your data room looks professional and clean and those type of items, that you're just, they don't like no one likes hair on the deal, right? So anything that you could eliminate out front as far as, hey, we know we have this, we're taking care of that. It's a lot better than them finding out diligence and you guys have to try to explain any, red flags or, something along those lines.
Yep. So, Chris, in the beginning, you talked a little bit about valuations, and obviously, most business owners think their business is worth more sometimes than it actually is. But another important aspect of valuation are valuation discounts. So, can you talk about how business owners can work towards achieving these discounts, and why is it important?
Yeah, it's funny because yeah, this whole first part, and yeah, it was all about how do you maximize the value of your business when you're looking at selling it, and how do you make it easy for the potential buyers to get in and see everything and feel confident in the value that they want to buy your business for. And now we're talking about valuation discounts, which is really, oh wait, how do we minimize the value of this
Mhm.
business? And then, of course, why would you even want to do that? So I guess the simple way to put it, if you think about it from a estate planning perspective, when you're looking at maybe gifting or selling some of your business to a trust, you actually want to minimize as much as you can the value of that business so that you can effectively maximize the amount of, say, your lifetime gift exemption. So valuation discounts essentially are a super powerful tool in the world of estate planning when you have a closely held business. The idea, just, again, sort of simply put, if you have a business and you sort of bifurcate into voting and non-voting shares, well, on paper, clearly the non-voting shares are going to be worth less than the voting shares. And that in and of itself creates this discount that you can use to transfer shares of your business into a trust, again, at a discount. That's just one of them. That's just one idea behind it. The other one, or another type of a valuation discount, might be what you call like a lack of marketability. So again, going back to that whole, I have lack of control because I have non-voting stock. Well, if you've also got a business that has a limited market to sell to because it's not a publicly traded company, so therefore the amount of potential buyers, hypothetical buyers at this point, is limited. Well, then there's also a discount on that as well, because sure, on paper maybe you're generating several $1 million a year in income, but if there's nobody willing to buy it, then from the outside world, it's not really worth a whole lot. So you're able to take that and again apply a discount to what those sort of minority shares might be, and really be able to transfer a lot of the business value into a trust at a discount. So just as an example, theoretically, if you could gift $10 million of assets and only use $7 million of your gift tax exemption because of a 30% discount, that's a very powerful way to, again, maximize the amount that you're able to move outside of your trust, or move outside of your estate into trust. And again, from an important perspective here, if you are subject to an estate tax liability, this helps really push down what your future estate tax liability is going to be in the future. And if you're using these special types of trusts called dynasty trust, then you're effectively removing that from the estate permanently for estate tax purposes for future generations. So again, the application of even a 30% discount today can have a huge waterfall effect on what the value is outside of your trust, inside your trust in the future.
And that might be more applicable sometimes to family businesses, right? It's more of an internal type of transition or succession planning where it makes sense for them to do that because they're not trying to just sell it to an outside organization or person. So they're doing this for a different reason in a different manner. So understanding there's valuations and then there's also valuation discounts. I know our audience wants to hear, but what do I have to do to get more money? And how can I pay less taxes? So let's talk about what are those actual strategies that you guys are all both experts in that can really make a difference when it comes in exit planning. So Mike, can you walk us through some of the most, and I know there's many, and once again, we can talk about this all day, but some of the most effective tax mitigation strategies that you've seen business owners use before a sale?
Yeah, absolutely. I love what you said earlier about, start with the end in mind. Like, what does that look like for, why are you building this company? What is this for? Is it to IPO? Is it to sell to a strategic? Is it to sell to private equity? Is it, for your children to carry on and, have a good business to run? Once you really understand, what your end goal is, you can really start to build that vehicle, your company, in a manner that minimizes your income tax drag. And, caveat that a little bit with, we never know, we don't know, we don't know. So we want to build in flexibility to that structure, to that plan. But if you have an end in mind, you can kind of back into what your best structure is at the front end, which will lead to the best result at the back end. So, that's kind of, I know that's not a specific strategy, but that's kind of an overlying thesis of, hey, if we really want to minimize our income tax on this thing when we sell it, well, let's know what's going to happen when we sell and structure this thing at the front end in order to achieve that goal.
Yeah.
And then, lastly, just touching on valuation discounts. From my perspective, the best valuation discount is when this company is just an idea, right? Ideas aren't worth a whole lot for estate tax value. Great opportune time to structure that in the right place, in the right trusts, in the right, wealth transfer vehicles at the front end, as far as the ownership of the entity, in a manner that we haven't used a lot of your gift exemption. It is asset protected, and then you can go forward to build this thing and eventually sell it. And we've already kind of taken care of that transfer of wealth outside of your taxable estate. So again, not specific strategies maybe, Celeste, but those are really the two overlying themes. When I talk to a business owner, it's, okay, who's going to want this thing? And then we can kind of determine how we want to structure it. And then, hey, do you think this is going to be, something that you want your grandkids to run? Or are we building it to sell in 3 years, building it to sell in 10 years? What does that valuation look like? And we can start building around, estate tax and asset protection vehicles around that as well. So it's really, the earlier you get out in front of it, the more income tax you can save in the long run.
Yeah, and I think also maybe having a plan B, right? Many times we talk to business owners who initially thought, well, this is for my family, and now their child grew up to be an influencer, right? How many families have we worked with where the children have no interest in the business, and maybe that was the initial goal, or it's been for a few generations, and now it's a different, generation that's just not interested in continuing it. So sometimes it's knowing, it's a great point, Mike, knowing what do I want this to look like on the back end, because every strategy is going to be dependent on what that is. But sometimes also thinking if it's not this, maybe there's a plan B involved too. Chris, I don't know if you have anything else to add as far as mitigation, or we can also move into talking about some of the things that you've seen used to spread out or defer some of that tax liability.
Yeah, sure. And you're right. Everything is always circumstantial. It's, what is the current situation? What is the end game to this? At least, currently in a vacuum. And as you both noted, that stuff can change over time. But, again, circumstantially, yeah, there's always, well, not always, but generally speaking, there's going to be ways to help defer some income taxes whenever you are looking at potentially selling your business. One that comes to mind would just be like a charitable remainder trust. That's where, you'd simply put in some business interest inside of that trust. That trust would pay you an income stream, i.e. the deferral on the income taxes. And then at the end of that, at the end of a specified duration, whatever's left inside that trust would go to charity. So you kind of had this kind of a mechanism where you're benefiting yourself through tax deferral, you're getting an income tax deduction, and then also you're benefiting a charity, which is awesome. There's sort of the opposite of that in a charitable lead trust. And then there's other types of techniques like, I don't know, opportunity zones and deferred sales trusts. And there's a litany of them. But again, it just comes down to what these circumstances are, what motivates the family, and then what they ultimately care about.
So many times when people or clients or advisors come to us and they ask us for advice or recommendations, it's like, it depends, right? So that's constantly the answer, because it really comes down to objectives, goals, what's important to that particular business owner, or maybe the organization as a whole, if there's, more family members involved. So it really does depend. I think the key takeaway is there are ways to spread out the taxes, defer, save on taxes, maximize the value of the business, but you have to do it, or you're going to get the most out of it if you're doing this in advance, if you're giving yourself time, maybe, far in advance of that LOI, so you can give yourself the opportunity to do the proper planning and really get the best out of it. In the beginning, we mentioned making it a great exit versus just a good exit, right? So It depends.
No, Celeste, when we do a lot of planning for, I got a great story around that where we had a client that had a very successful exit because they leveraged qualified small business stock exemptions. They were able to structure in a manner that they got pretty much the entire transaction, capital gains and income tax free. And as they, as serial entrepreneurs do, they went to, start up their next thing. And right away, then they and their attorney came over and said, well, we're going to do a C Corp, right, again, because we want to do this QSBS thing. It was a qualified small business thing. It was fantastic. I paid zero taxes on this thing. It's like, well, it's not a one size fits all opportunity, right? There's a lot of different factors when you make that decision to be a C corporation as far as double taxation. Will they buy the stock versus will the potential buyer want to buy your assets in this company? So there are a lot of good tools, but I think you nailed it. It's very facts and circumstantial, and you really need to understand, okay, what's the ultimate goal of this thing before you just say, well, QSBS is best thing since sliced bread. We're going to do C corps for everything. Might be the right answer, but at the end of the day, you really need to tread carefully into some of these structures because they would be inflexible, and you might have detrimental tax attributes as you exit if you're not being thoughtful about what does this look like in the long term, but also B, let's make sure that we do have some flexibility if circumstances change, tax law changes, that we still won't lock ourselves into a poor tax position.
Yeah, we don't know who the next president's going to be. I think during our lifetime, there's an average of like 7 or 10 presidents, something like that. I heard a statistic the other day. So you just never know like what that tax law. That's a very good point, Mike. Maybe if you can expand on that QSBS exemption, what it is, because it kind of is pretty great. It kind of is better than sliced bread, but it has to be for the right business. So if you can just explain what it is and how people can take advantage of it.
Yeah, absolutely. So, when tax law most recently changed and the C corporation rates dropped down to 21%, a lot of individuals were looking to, either starting up or reorganize their current structure to say, well, why wouldn't I want to have the lowest effective tax rate? Which makes sense on its face, but, C corporations come with double taxation, so there's something to think about there. But the overlooked benefit most of the time of C corporations is, if you do qualify as a small business under the regulations, you would be able to exempt the lesser of greater of $10 million or 10 times your basis in those shares. So, that's a great opportunity for someone who's selling a small business on the exit, if they do the right things to qualify as a QSBS company, to eliminate the first $10 million of capital gains on that sale, or in some circumstances more, depending on your outside basis in that company. What we do a lot of is taking that $10 million bite of the apple and do certain gifting and trusts around that to have a handful of $10 million exclusions along the way. So that's great planning for a lot of families. And then coupled with maybe some out-of-state trusts. So we're eliminating, $10 million of federal tax per trust, and then also getting it out of high income tax states. So, that's great for New York, New Jersey, California business owners that, okay, we have a great federal exemption as well as a full state exclusion because we're no longer selling the stock out of New York, New Jersey, California, etc. So, no, that's a great example of something that could be an absolute home run if someone's a little more thoughtful at the front end, as far as just saying, hey, I'll be an LLC because everyone's an LLC. Tax the partnership, like, well, maybe, but if we can, structure as a C corp at the front end, understand that we would be subject to double taxation while we're running this thing. So make sure that we're minimizing that double taxation, or we just have proper use for the cash flow of the company. Eyeing a QSBS exit and then maximizing that QSBS benefit is an absolute home run for the right type of business owner.
Yeah, I mean, there were so many startups. You're right, around the COVID timeframe, people investing in new things starting. Now with AI, I feel like there's a new business every single day that's being created around it. So there are a lot of opportunities for people to take advantage of this and start early in that planning. Chris, another thing we hear sometimes are ESOPs, and our audience may have heard of it, but not know what it is. Can you talk about what is it? What are the tax advantages? Who is it for?
Yeah, sure. Yeah, I know in the beginning part of this, we were really talking about what happens if you sell your business to, say, a third party, private equity coming in and buying you out, or maybe your biggest competitors coming in and buying you out. Well, sometimes either that doesn't work, it doesn't make sense, or philosophically you want to have a different approach. And so what an ESOP does, it stands for an employee stock ownership plan. And what that really does is allow you to, a business owner, to effectively sell their business to their employees through a trust. So it's a unique exit strategy that does create that exit, that liquidity for the business owner, and really transfer of business interest down to the employees, which is awesome. So if you're one of those companies that's like, I love my employees, I want this company to go on to perpetuity, and I want to relinquish my control at some point down to the existing management team, and I don't want third parties coming in and touching my company. Like, this could be a really fantastic way um, to, again, sell your business, but sell it to those people that helps you make the business what it is, your employees ultimately. The company itself, since you asked specifically about sort of the tax benefits of doing it, the company itself can make tax deductible contributions to the ESOP. So that's part of how the ESOP gets funded. So you do have some tax benefits there. And then also for the seller themselves, and again, everything is subject to caveat and meeting the certain conditions. But it is possible for the shareholders of that corporation, whenever they're selling it, to defer capital gains as well underneath the Section 1042 rollover. So there's different ways to, again, sort of empower your team, to now be owners. You get the liquidity, and then also find ways to defer those taxes so you're not all hit right up front.
Yeah, so that's another thing to remember. It's maybe not an organization, it's not your family, it's your employees,
Yeah.
it's those loyal folks that were there from the beginning. And maybe, as we've mentioned before, that wasn't the initial plan. We were presented a client by an advisor who has a lot of property, doesn't know what to do with it, a lot of rental property, but he's had these great loyal employees for a long time, doesn't have heirs to really transition the business to, try and decide what to do. An ESOP could be a consideration, right? Just because of his particular situation. And we do see this used quite a bit by owners that just find it, like you said, they want to transition to somebody they know can appreciate that baby that they've worked on for so long, and know how to manage that business. So all of these great strategies, once again, it just comes down to objectives. What is the purpose? What is the intent? And then what makes sense, and give yourself time for the planning. But there's one tool that we personally love, but that is often overlooked in pre-sale planning, which is life insurance. So that's an area where in our firm, Robin Glen, we have a lot of expertise. And life insurance can also help when it comes to transitioning that business and, mitigating taxes, maximizing the value. But there's a lot of I wouldn't even say misconception. I think there's just a lot of lack of knowledge of how it can be integrated into some of these strategies. So, Chris, how can, kind of high level, how can life insurance be used in business planning in this pre-sale business planning to mitigate taxes and maximize the value of the business?
Yeah, for sure. I think there's there's a couple of areas that I think life insurance can be really useful. So one part would be if you have key individuals. Let's say you have a very, very strong management team or a very, very strong sales team that is absolutely integral to the performance of the company. Whoever that potential buyer that's coming in and looking at that, they're going to want to know that those individuals, those key people, are locked down. They're going to want to know that once this business sales, and that now that company, that entity is transferred to me, and I'm now responsible for it, that all those people that, again, made that company what it was, are going to stick around for the long haul, because without them the company becomes less. And so using things like key person insurance, where if hypothetically you were to lose a salesperson because of a disability or maybe death, that there's some sort of an influx of capital to help replace that person is key. And then on the other side, if you are able to lock up some of those folks with more deferred compensation plans, things like using split dollar plans, or maybe a 162 REBA kind of life insurance plan, where it really behooves the employee or executive or salesperson to stay on for the long haul, because they're going to have that economic windfall themselves by way of that life insurance policy that really creates that golden handcuffs to keep them in. If I'm a potential buyer and I'm looking at a company and somebody had the foresight to put those types of things in there, that's going to give me a lot more comfort in, one, the value that I'm paying for it, and two, that those people are going to stick around for quite some time. So that's just one way that I think that insurance can be utilized, when it comes to somebody else looking at buying your company. The other thing, and this is a little bit different than, again, a third party buying it, but let's say it's two partners. In the event that one of those partners passes away, well, 50% of the company is now going to be owned by a spouse. or maybe it's their heirs, or whoever it might be, however their played itself out. So this is where like the idea of a buy-sell arrangement really comes into play, because most business owners don't necessarily want to go into business or have to make key business decisions with heirs of their partner, or the spouse of the partner. So having a well-funded buy-sell agreement in place that allows the surviving business owner to again buy out the shares of the partner who is no longer there, is also critical. And life insurance plays a significant role there, because it really provides the liquidity to facilitate that transaction without having to cause additional loans, or arguments about sale prices and values and all the other stuff.
Yeah, and many times we see buy-sell agreements that are in place, but we're never funded, right? They're just
Yeah.
there. So when it
Yeah.
comes down to needing the liquidity, there's nothing to provide it. We had a situation with some clients who were college roommates, had started a very successful IT business, had been in business for years. One of them passed away, and they didn't even have a buy-sell agreement, but there was definitely no liquidity there to, buy out the spouse, who the surviving business owner did not get along with at all. It was also, I think, the third spouse of this person, the one that passed away. And so it was a complete mess when she wanted to be part of the business, did not want to sell, there was no real solution. And they ended up just selling the business because they just could not get along. After having, a long time successful business that was thriving, it just really messed up the dynamic, and they had different visions about where to go. And you also have a person that had no business being involved, but she could, right? So it
Yeah.
happens. So a perfect example of, once again, pre-planning, because that exit, while it could be a lucrative one for you, it might also be, unfortunately, an unplanned exit where there's a death or some kind of, disability or other scenario like that too.
Yeah, no, that's absolutely right. The unintended consequences of I want to plan for this and haven't done it yet. That's key there. We've had I've seen several instances where really the impetus to actually fund the buy sell arrangement was because the company actually had something happen and maybe lost one of their partners, and all of a sudden they went, oh shoot, this is actually a problem. Now we'll plan for this. So if you're out there and you're listening to this, getting ahead of those types of things before something like that happens is really, really important.
And something we haven't touched on, but we mentioned this in a previous episode, is the importance of having the right advisors in place. We had referenced it before as kind of like having your exit advisory team, because you mentioned, Mike, having your attorney, having your CPA, but then, there's other folks, for example, your insurance advisors. There might be other ancillary advisors that have a very specific expertise they can bring to the table that's going to be really important in your overall planning. So ensuring that sometimes, business owners think, well, it's expensive, I just don't want to have more people to pay or more things to pay. But long term, it could be a lot more expensive to not have that right team that has that specialized expertise that can really protect your business, your value, your money, your wealth, your children's wealth over time. So many reasons to have the right advisors. So Mike, can you talk a little bit about, we've heard maybe the term, or audience maybe has heard about estate freezing, and what that is, like how can life insurance be used as part of that, and how it can reduce estate taxes?
Sure. So, at its basic level, an estate tax freeze is essentially taking a business or an asset that has high appreciation potential and selling it at those lower discounted rates that Chris is referring to a trust for your family in exchange for a promissory note. So where the freeze comes into play is, if you sell that company for $20 million, take back a $20 million promissory note, as that company grows from 20 to 40 to $100 million of enterprise value, your estate is still frozen at that promissory note principal value. So that 20 million. So, that's kind of our first, entry to estate tax, planning is, well, here's where we're at now. We can, with relative certainty, slow the acceleration of the growth of your estate value by implementing certain freeze techniques. And then where life insurance comes into play is, we've been discussing, the ability to maintain flexibility as far as, different types of exits, or if we want to pass our business on to the next generation. one of the biggest hurdles for flexibility is lack of liquidity to pay estate tax, right?
Mm-hmm.
So, best laid plans, you want to let your children or one of your children, run your business, but your business is worth $100 million in your estate. So now they have to come up with $40 million somehow to maintain that business because they have to pay estate tax. So their options are, borrow, it's heavily, weigh on the cash flow of the company, or what happens most times than not is a fire sale at a lower valuation of the company that you want to run or you want them to inherit. So that's, when I think about, let's freeze the estate, let's minimize that estate tax. And then B, how are we going to pay this estate tax without significantly hampering your lifetime legacy company? Because, when we talk to business owners, sure, they might say, okay, well, I want to make sure that my business isn't getting crushed by this estate tax, or, God forbid, my husband has to sell this thing in the next, 9 months in order to pay my estate tax. It's more, but what about the employees, kind of the indirect beneficiaries of your estate planning? Solid estate planning that provides for that payment of that estate tax without hurting the company is meaningful not only for your children, but for your business. If you have 100, 200 people working for your company and your spouse or child is forced to sell because they can't pay estate tax, those 100, 200 people may or may not have a job, in the next year or two. So that's, this type of things we help people think about is A, let's minimize that number that we have to, take care of at your passing. But B, let's use insurance as a strategic tool to make sure that that business, whether or not the child wants to sell it, I know they don't want to be forced to sell it. So let's make sure that they have enough liquidity to brighten up your estate and run this company in a manner that is least impacted by the payment of estate tax.
Yeah. I mean, cash gives you options, right? It doesn't matter where
That's all it is.
Yeah. It doesn't matter where you talk about the cash. It's going to give you options. People like to cash, it's going to give you that flexibility. And many times, we talk about wealthy doesn't mean liquid. And most of the time we see that our clients are not liquid because they're serial entrepreneurs. They're consistently investing in other things as they should, or in real estate, or, it's tied up in new ideas, new startups, new ventures that they're working on. And so it's very common to see folks that are wealthy but incredibly illiquid, and if that estate tax is due, the government's not going to care where it comes from. They're just going to want their money. So it might be that we talk about this all the time, but it's important for people to remember it could be the wrong time to sell the business. It could be the wrong asset to sell for that timing. So if you have that liquidity, it just makes it so much easier to be done with that and move on with everything else that's left.
Right. Like, I know I'm just harping on flexibility, but if you think you have a client of ours has a legacy asset they want to pass on a generation, they've appropriately put in the right amount of life insurance to take care of it. Someone comes in with the Godfather offer and they end up selling the company anyways. I've never had a client that upset that they also had this diversified bucket of life insurance. But the reverse,
yeah.
If they said, you know what, I'm going to sell it, we'll be fine, we'll have enough liquid cash, they don't end up selling it and they have a premature death, that lack of flexibility always hurts the family. So even if you earmark this bucket for liquid estate tax value and you end up selling your company, you're completely 100% liquid, no one's really that upset that they still have this diversified portfolio of life insurance policies versus the alternative.
Yeah. And we also talk about charitable planning because there are some great techniques you can use there to mitigate taxes. And a lot of our clients are very charitable, give a lot to nonprofits. But sometimes, Chris, you had mentioned a charitable remainder trust, which is a great vehicle. We've actually been talking about them a lot lately because of everything that's happening, potential estate tax changes. But sometimes clients say, I love the concept of, putting it in there, deferring the taxes or reducing my taxes, getting the income, but I don't want to leave that much to that nonprofit or a nonprofit because I want my family to get it. So how can life insurance tie into that scenario?
Yeah, for sure. There's always a way to balance those things out. So yeah, if you're looking at something like a charitable remainder trust, like we were just we're talking about, and whatever that amount that might go to charity at the end of that term, well, your kids aren't going to get that. The charity's going to get that. So a lot of instances will pair that kind of a structure up with what we call a wealth replacement trust, which is really funded with insurance. So a lot of our clients will take that annuity stream from that trust and then use a portion of that to buy a life insurance policy that essentially offsets the amount that goes to the charity underneath that charitable trust. So that's one way. The other way, of course, is to ratchet up and down, how much you actually want to leave to the charity at the end of the term to help maximize the maybe the annuity stream going to you. And there's some that plays in how the deductions work, but there's different levers you can use there. And then there's other types of charitable structures you can use well. I mean, you could use maybe donor advised funds, or if you're wealthy enough, maybe you could use a private foundation and sort of roll your family into it so they can start learning some of the family values and things that you care about and help perpetuate those things. That kind of goes back to that whole idea of a family legacy, community legacy that was kind of touched on by Mike. And a lot of this, whenever I think about this and whenever I'm talking to families about it, because it's not, I mean, we're talking a whole lot about the numbers and sort of the offsetting, but the amount of stress that can be alleviated by having a death benefit pour into the estate, providing that liquidity, can be wildly impactful. So like when something tragic like that happens and the owner of a business passes away, you really want the focus to be on that person's legacy, not trying to stress out what assets are we going to sell, how are we going to get substantial loan to help cover estate taxes, and who's going to have to make those key decisions. I mean, that can be wildly stressful for families. And so when you have some sort of an asset that can inject that kind of cash to help buy some time on some of those decisions that have to be made, or even offsetting, again, that estate tax is really, really important.
Yeah, and we can have 100 stories probably between us of situations
Really.
that we saw where the planning wasn't there, or the planning was, and how wildly different those situations ended up being, even
Yeah.
long term, from the overall wealth that was transitioned or not, the businesses that were kept or successful. So yeah, that once again, cash is king. It always will be. So having it is important in planning. So just kind of to wrap up this, part of our conversation, life insurance is an option. There are ways to incorporate it into the planning. It has to be in the right spot. We always talk about ensuring that we're right sizing the insurance, so ensuring other planning has been done, and fitting it in when it makes sense as well. But it's something that to be considered and not to just be overlooked.
Right.
So, we've talked, there's all these great strategies. Once again, depends on what they want to do, intent, purpose, goals. But then we talk about actually implementing them, right? Because it's great to talk about it, but we actually need to take action and do things to get these strategies implemented. And Mike, I know you've already talked about some of this on the front end, but as far as what is a process for a business owner to implement some of these strategies, specific advisors they have to use, but anything else that you would add as far as important things to remember when it comes to implementing these strategies?
Yeah. So I think, when you think about the amount of strategies that are kind of available to a business owner who's looking to sell, yeah, it just, you can kind of look at that as like a time spectrum. If, like you said, we start with the end in mind, we have the full gamut of strategy available to us. If we're thinking about exit 3 to 5 years, well, maybe we have, 50% of those strategies available to us. A year before exit, maybe we have 10% of the strategies available to us. So it's all, there's always something that you could do as far as pre-sale transaction, but you're just limited the closer you get to that deal table. So, it's always, if hindsight's 20/20, but if you could always get out in front of any of these transactions, the further you're out in front of it, the better off you'll be in the long run as far as those things. And then if there is charitable intent, marrying these with some charitable planning, 3 to 5 years in front of an exit is just more impactful than trying to do it, right at the closing table as far as funding charitable trusts or those type of items. So it's really, there's always something that can be done. I'll never say, you've eliminated all of your opportunity, but every year that goes by, you do take a few of these tax strategies, or at least their impact up, and the full power of their impact off the table the closer you get to closing table.
Yeah, and as there's, especially in a family business, and maybe Chris, you can talk a little bit about this, but in a family business, there's new people that come into play throughout the lifespan of that business, right? It might be sometimes it's not even a family, it might be a spouse, or it might be, cousins that are not as close. So when we're making these decisions or when we're talking about pre-sale planning, like who should be involved in these conversations?
Yeah, I mean, there's always I guess there's a balance there, and you can always say it sort of depends on what the situation is and sort of the dynamics between the family, the business owner, and maybe key individuals inside of the business itself. But obviously, you have to have the business owners involved. I think that's obvious. To your point about the people inside of the business itself, a lot of times what we'll find whenever we start sort of pulling apart the onion, the layers, if you will, we start discovering that some individuals inside of that business are sort of operating like a pseudo family office where they're actually doing quite a bit for specifically for the family or the business owners themselves, and maybe less with the business. So sometimes those individuals can play a key role because they know so much about the family, and so some of that dynamic that they can bring to the table and understanding about how circumstances got from point A to point B can be very, very important as well. Family members, absolutely. If you have heirs that are going to be involved in it, your children, absolutely. Your spouse, if anybody in the family tree is involved in the business, incorporating all of them into the conversation as early as possible is important because you're going to get a better idea of who's actually interested in maybe staying on with the business, maybe who wants to move on, what kind of roles, the current business owner thinks that some of those individuals can take, and maybe what they want to take. So just trying to unlock some of those dynamics can really play a role in how like sort of the future state of the company or that liquidity might play itself out. And then you have the wealth of advisors behind that. You're going to have your attorney, you're going to have your CPA, you're going to have your wealth manager, and then you're going to have a litany of specialists who, if we pick certain types of structures or certain types of concepts to implement, then we're going to have to find those as well. And that's kind of admittedly, I'll say it's kind of a shameless plug for us because not only do we understand, does Robin Glen understand all of these concepts and how to sort of unlock them for families, but we also know how to manage them and almost operate as like a general contractor to help make sure that it's all implemented correctly. So there's quite a few, again, depending on circumstances, that could be involved and who should be involved.
Yeah, there could be so many different stakeholders. And then, of course,
Totally.
there's that level of confidentiality that you want to maintain at times in the sale. You want to let some people know and others maybe on a need to know basis, depending on their level of involvement or how key they are to the success of the business. And then there's also after the business is sold, or maybe there's concerns about keeping a key employee, retaining them. Are they going to leave? Is the buyer concerned about that? And just once again, to your, like you said, shameless plug to a little bit of life insurance. That's another way, right? If you have those golden handcuffs on them, that's a way to ensure that you can retain, or the buyer can retain those employees too. And in a future episode, we're going to talk a lot more about that post-sale planning too. So we've talked about, before, and this has been brought up in several of our previous episodes in the series, is how these businesses are their baby, right? It's the business owner's baby. And I will repeat this again because I thought it was such an interesting just a piece of information that another guest shared, where talking about your business triggers the same part of your brain as talking about your children. So that goes to show how emotionally connected a business owner is to their business many times. And they're concerned about that legacy. They're concerned about what's going to happen after I'm not here. Or even if they sell it, a part of them is always worried about, is it going to be to the right person? So Mike, just kind of so we can wrap up, there's been a great conversation. We kind of wrap up, and we've already touched on it some, but for those owners that are concerned about their legacy, what's going to happen next, how can these pre-sale strategies help them kind of put them at ease of those concerns?
Yeah. So, it all starts with, that estate tax minimization, whenever we're thinking, we need to, kind of just not worrying about it isn't a plan, right? Not, oh, my kids have enough money, or or I just, I'm too busy to figure this out. Like that's well, lack of paying attention to something is not going to be a successful, business succession plan. So it's really okay. I understand that I have this company that has 100 employees that does this, this, and this. I want to make sure that this is being, transitioned down to my daughter, my son, my daughter and son, whoever's going to be running this business, and that they will be able to succeed, right? And it just comes with minimizing the estate tax drag, and then ensuring that you have the ability to pay that eventual estate tax. I have a lot of situations where daughter comes into the company as successor to mom or dad, and she's really just not put in a position to succeed. And to the key employees or even the non-key employees, it makes it seem to the kind of outsider that she's just not, mom ran this company XYZ. She's always doing this right, that right, this right. And then son or daughter come in and they're like, well, he's cutting this, he's breaking this down to the studs, he's looking to sell. And it's not their nature or what they want to do, but it's just forced by the lack of planning beforehand. So, if they need liquidity, they're going to have to look at their crown jewel, their family, for that liquidity if they don't have it somewhere else. So if a business owner is really concerned about, the legacy of their company, it's really ensuring that there's liquidity to take care of their potential death, their eventual death. And then secondarily, if there are multiple inheritors and only one or two are going to work in the company, that the non-participating children will A, know the deal, but B, be made whole, or, as far as whatever you want them to inherit, so that they don't cause disruption in the company. That a lot of times it's the non-participating child who has issue with how their brother is running the company. So to alleviate a lot of that, it's really putting not only an estate plan in place, but a continuity plan to say, hey, my daughter, your sister's going to run the company. This is what she's inheriting. You're getting this. Like, does everyone understand the why behind what we're doing? That often, leads to a lot more successful business succession, opposed to, just kind of black sheeping them out of there, and hopefully they don't cause too much trouble if they continue to get their dividend checks.
I love that comment, because it's like, people forget about this, but not making a decision is also making a decision, right? And I think that, if you look at sort of some public things that have happened recently, you see the Murdochs kind of going through what they're going through out there in Nevada, trying to figure out who's going to take that organization over, and maybe what's going to happen to the other potential heirs out of that. So you see these things kind of play out over there. And then again, to that idea of, some people plan and some people don't, not to bring it back to music. Obviously I love music, it's what it is. But when you sort of look at the two estates of Prince versus Bowie, and you could argue David Bowie, you could argue that both of those are companies in and of themselves. One was a total train wreck disaster and is still suing and still trying to figure that out. The other one is a marketing machine right now and is producing probably a ton of income for that particular trust. So I'll let you, you could Google it and probably guess which is which. But
so who do you want to be, Prince or Bowie? Yeah, absolutely. So prepare your heirs. And as another estate planning attorney said before, we're all going to die. So unfortunately, we all need to just, prepare for what the eventuality of things will be. But yeah, the key is prepare. Give yourself time when you have it. Ensure you're surrounding yourself with the right advisors that can prepare you accordingly. And just keep an open mind too to the fact that things change and you may have to pivot at a time, or pivot to a strategy, or at a time that you didn't expect to. So we've talked about a lot of different things, and this has all been great. If there was one thing that either of you or both of you would say as soon as they stop listening to our podcast, so not yet, as soon as this is over, one action step you'd recommend for business owners to take, what would that be?
I think that it would be good for them to sit down with a professional and help them outline what they actually want to happen with their business and their estate. And then, probably at the same time, maybe with that individual, also start setting up a series of family meetings to just start talking through what that actually means for the family, and where that business owner where they're thinking. I think that communication is key for these, whether it's stakeholders inside the company, the advisors, or in particular the families themselves. And the earlier that they start talking seriously about those things with each one of those stakeholders is wildly important.
I'll piggyback on that. The transparency and the openness of having family meetings, not only family meetings, but advisor meetings. They're awkward and clunky at first, right? If we throw a quarterly family meeting on the books, and those first few are just like, they're odd, they're pulling teeth, but pretty soon you find your groove. But more importantly, just having that transparency across your advisory group. It's not, it's just, like a good example is you put your estate plan together and you want X amount to go to your children and Y to flush to charity. Your estate planner says, oh, that's a fantastic strategy. Your income tax planner knows nothing about this. And then meanwhile, you're knocking on your CPA's door going, why am I paying so much income tax on an annual basis? Is there anything I could do to this? Well, if those two talk, they could probably come up with a good during life solution to utilize your charitable intent. But that kind of, that wall between them and the inability to kind of cross those things, it allows for not great planning. I hate using the word holistic because everyone's a holistic planner, but when you're a business owner, you really need everyone talking at the advisory level and then at the familial level to make sure that everything's going to continue to run smoothly.
It's like a fire drill, right? When you plan for it, everybody knows what they're supposed to do. Hopefully the building doesn't burn down and we've mitigated as much loss as possible. So it's a fire.
One of the most successful families, not successful money-wise, but just like what I consider successful as far as, business succession and wealth succession, they would do like, during these quarterly meetings, they do like almost hypotheticals. Okay, XYZ happens, like what happens to the company, what happens to this, what trustee does this. And at first I thought it was the cheesiest thing I've ever seen. I was a little younger at the time, like, wow, this is so weird. But like it works. Like, and I'm not saying you have to do a full play every time you get together, but like those type of things that are important because when something does happen, there's a lot of emotions at play. So having at least a little stability and a core foundation of, okay, we kind of understand how this plays out to a degree. It's extremely meaningful for families, especially families that have businesses and employees that depend on them.
Absolutely. It's those ancillary people too that are impacted. And many times business owners love their employees too and really worry about them. And so they're such a key part of that planning, and it's much better than the alternative where you say, I'm not going to tell my kids how much they're going to get because, I don't want to spoil them. And then it's a disaster because they get nothing as everything goes to the government or gets lost, right? Because they're all fighting for it. So definitely planning is the key. Well, thank you both so much. This has been really good information. We appreciate it. This has been a key part of our business planning series because it's so important to emphasize the pre-planning. Everybody thinks of, I'm going to get to the sale. I'm going to sail. I'm going to be so rich. I'm going to sail off into the sunset maybe. But the way to get there is really by all the pre-planning that has to be done before. So thank you both very much for being on today.
Yeah, I appreciate the time. It's fun.
Yeah, thank you, Celeste.
For those of you looking to connect with our guest or myself for further guidance, we'll include our contact information in the show notes. We encourage all business owners to take a hard look at their exit plan. And if you haven't started planning, now is the time to do it so you can find those right advisors that help you plan that successful exit. Make sure you tune in to our next episode because we are going to have a business owner share their own personal exit experience, along with some of the emotional aspects of exiting a business and how to ensure a smooth transition. Also, make sure to check out our show notes for other links and resources. And if you enjoyed what we shared today, please like, subscribe, and share our podcast. As always, thank you so much for joining us for another episode of Planning Reimagined, where your wealth journey meets our expert insights. See you in the next episode.
Thanks for listening. Don't forget to like and subscribe. And please be sure to follow on your favorite podcast player. To connect with us, you can email us at hello@robinglen.com or schedule some time with us via the link in the show notes. You can also find us on Instagram and TikTok at Hello Robin Glen.